the topic of the next 10 to 12 minutes is investment strategies for wealthy families. Sounds like one of those books. You go in and you go and look in the business section. It's got investment strategies for wealthy families. You pick it up, you look at it and you say, oh, goodness me, it's not for me, because firstly, I'm not wealthy, and secondly, I don't believe a word of it. In the studio with us tonight in Johannesburg is Kerry Fynn, the CEO of AlphaWealth. One thing I wanted, a sort of a curveball I want to throw at you, Kerry, is that there's wealthy families, first generation, second generation, third generation, fourth generation, etc. First generation is easy. You've made your money, you're all happy, and you're all enjoying it. Second generation, they start to squabble. Must be very difficult for companies like yours.
I think that's an entirely different aspect, Lindsay, but certainly, yeah, not an easy one at all. And I think, you know, families handle the situation differently, each one of them, and it's a major factor in sort of the successful transition of wealth. But yeah, it's complicated from a psychological perspective, but certainly an important part of the business.
Are there any generalizations, Kerry, that we can extrapolate and say this is how wealthy families generally grow their pot?
Sure. I think there are quite a few, and I think a lot of them are common sense strategies, to be honest with you. I think that the first thing is that what I've noticed as a trend in wealthy families is not an over-diversification, so a willingness to take sort of high conviction bets when they feel that an investment is representing fair value or extreme value. And also another thing that I find is often lacking is in the general investor market, as opposed to very successful investors, is an attention to illiquidity, for example. You know, if you're prepared to take some sort of liquidity risk over a period of time, and that means a longer term time horizon, can often lead to much greater compound annual returns sort of in the portfolio.
Kerry, do you find wealthy families still harbour or warehouse their wealth in trusts? Is it still very much part of your business to look after trusts and to govern trusts, or are they a little more fluid these days?
No, David, I think asset protection mechanisms are still very important, I think, for wealthy families for a whole bunch of reasons, you know, but I mean, I think typically in the past, trusts were often seen as a way to shield investments from tax. I think that's much less the case today. You know, I think you know, there are ways to obviously create a tax-efficient portfolio and lower your cost of taxes in the portfolio. But generally now it's more about succession planning and making sure that those funds are passed on to future generations in the way that the founder originally wanted them to be. Protection from creditors, estate planning, you know, that kind of thing but definitely an important part of the portfolio.
Kerry, what's the difference between planning for a family and planning for a couple, or planning for an individual? Because what I said earlier on was not frivolous at all, because I've seen it so many times, where different parts of the family want different things. There are certain people that are takers of risk, other people that are very, very conservative. So you have to almost have a psychologist in your team or a mediator in your team. So there must be different strategies for families, individuals and couples.
Yes, that's absolutely right. I think one of the important parts of this business is actually helping couples or families or units to basically define a common investment strategy. So I mean, I think that's part of the process, is working through that and actually working out, you know, what everybody wants. The reality is most people want the same thing, you know, out of their investment strategy, right, which is to generate the highest compound annual return with the lowest possible risk. You know, as David will know, you know, that's the lowest cost. Absolutely, that's sort of the general mandate that's given to most investment managers. But I think, you know, certainly a part of the education process is walking those family units through, Lindsay, through the different objectives and risk profiles, and you know, and kind of making sure that all family members are on the same page. Otherwise, you know, it can lead to massive dislocation sort of in these families. It's
Kerry, there's an article that you're quoted in talking about alternative asset classes and how high net worth families have a greater appetite for these. Maybe just talk us through some of these alternative asset classes, what they are in general, but also how they compare with the kind of mandate that you usually receive from these families.
Okay, Nozi, I'm so glad you asked that question. It's probably my favorite topic. I think that this all started for me, or certainly for us as a firm, about 10 years ago when one of our directors went to Harvard. He was doing an MBA at Harvard, looked at the Harvard Endowment Fund, and he said, how come these guys have managed to generate compound annual returns of 15-16% in US dollars over 30 years with a big pool of capital? And it's a good question, you know, so how have they way outperformed the top 1% of US money managers over an extended period of time? And when we looked into that and we drilled down further into that question, we realized that it was their willingness to invest a significant amount of their capital in alternative strategies. And so to answer your question more specifically, we're talking about things like private equity, hedge funds, and there are hedge funds and there are hedge funds, right? So, I mean, it's a broad category that, but hedge funds, real assets. So timber, I mean, timber's a phenomenally underappreciated asset classes for most retail investors. Timber's had 4 years of negative returns in half a decade. It's generated inflation plus 9% in US dollars over 100 years. You know, it's an incredible asset class. It's a great hedge against inflation. It's completely uncorrelated to stocks and bonds. These are the things I think that not only wealthy families who have that kind of capital to invest, but all investors should be looking at. You know, today with ETFs and exposure to these types of asset class much more readily available than they were 20 years ago, they should be used as tools in people's portfolios. They're not. So, I mean, that's kind of our research really comes from that sort of endowment model of investing popularized by David Swenson, which is, you know, and the numbers speak for themselves. You know, it's unarguable.
So you can literally watch trees grow. I mean,
well, that's it. I mean, yeah, 60% of those.
Are you implementing much of that here? I mean, are you trying to? Can you find the kind of asset classes to do that?
I think from a South African perspective, some of it yes, and some of it no. And what I mean by that is, for example, hedge funds in South Africa. I think we've got an incredible range of hedge fund managers in South Africa. We've got a nascent industry that kind of took best of breed from all over the world, and it's, you know, we have some amazing talent in SA. And if you look at the top managers on the hedge side, they've generated incredible risk-adjusted returns, net of fees. You know, so I mean, net of all costs. But obviously, things like private equity, hard to get exposure to in a South African context as a retail investor. Globally, you can buy Blackstone now, listed company, Carlyle, KKR. These are incredible businesses trading on PEs of sub 10 and dividend yields of 6 or 7. You know, talking about a $16-17 billion business with amazing track records. You know, so yes, I think, you know, as the global market opens up, though, David, you can you can invest offshore.
We're about to get kicked out of the studio, so thank you so much, Kerry, for that insight. And that brings us to the end of Investment 360.